Hey everyone, welcome back to Watch Your Six. I'm your host, Jason Edwards. We're glad to have you here. And then today in studio, we've got one of our other financial planners, Nicole Verde. Nicole, nice to have you.
Thank you so much for having me.
No, I'm excited. So today we're going to talk about a couple of different topics. First of all, we're going to talk about, the pessimism and the optimism and how those really impact your investments. We're going to get into some of the analytical data that we see. We just recently had an opportunity to do a market update for another institution, and there are a lot of things that fundamentally you can look at will help you understand where you may want to put your money. And then last but not least, we're going to do Jason's Fast Five, and we'll have Nicole in the studio today. She'll be handling that for us, so we're going to be excited about that. As well as we're going to give you more information about the ebook. We're excited to talk about what's going on with that, so make sure you listen in for the rest of the podcast. And at the end, we'll get into a little about the ebook and that resource that's out there. So to begin with, I want to talk about, especially towards the end of the year, there is a lot of different way that we use our emotions to dictate our actions. So during the holiday season, for example, people have a propensity to be maybe a little bit positive. Some could be fighting some negative feelings, and those all translate to what you do with your life. And investing, it's no different. If you have a feeling that you feel like the world's against me, I'm not going to make any money, it's impossibly successful, well, guess what's going to happen? You will not be successful. Why? Because your actions will be dictated by your emotion. So we think it's really important when it comes to investing, and more specifically trying to be successful at any level that you want to be at, you want to ensure that there's a positive focus there. Now, fundamentally, the data we see helps drive that focus. So when we hear, maybe the talking heads say, well, housing prices are high, or inflation's a little bit here, or the economy's not doing as well as it could be, we want to push back on some of those points with actual data. So let's talk about the economy. Today, we actually just got the most recent GDP, and those of you who aren't aware, GDP is how you determine how a government grows. How successful financially does it do? And in this case, our GDP was over 4%. That's astronomical. That means that the economy grew at a level of over 4% in the last quarter. So that would highlight as an indicator that economically things are going in the right direction. And we're going to get it a little bit later, discussions of what we call headwinds or tailwinds. But that's an incredible resource. Now, when you talk about housing prices, yeah, housing prices can be high, but if you're looking at housing prices and comparing the median price and saying, well, the median price is 300 to 400, that's also taking into fact some of the most expensive housing markets in the country. In the world, for example, if you take New York and California, you roll those in, well, yeah, the housing prices are astronomical. But if you're looking to move in places like Tennessee, South Carolina, some of these other more moderate areas, you can get really good pricing on properties at a much more reasonable rate. So the opportunity is there if you do your homework, if you do your due diligence. And last but not least, economically, from a perspective of building a company, of creating some type of wealth and success in this environment, there's never been a better environment for that. You've got interest rates starting to come down. You've got inflation starting to come down. Gas, for example, as national average is below $3, hasn't been that low in 2 years. You've got some incredible opportunities. So let's look at the positive, not negative. We've got an environment now with AI, with internet access, social media, I mean, the list goes on and on of resources, that you could be as successful as you want to be, but it depends on you. So financially, we see incredible opportunities. Now, in our world, there are things we use to determine how markets fluctuate, how they adjust. There are things that we call them headwinds and tailwinds. Those are just indicators that economists use to try to see what kind of headwind, as you can imagine the description, what kind of buffer or what kind of hurdle will the economy have to withstand, or tailwind. What kind of motivator, what kind of benefit is it getting, what kind of resources is it getting. So when you look at those two, there's some incredible things out there that we see right now. Now, when you break down the globe economically, we try to maybe portion to three different sectors. You've got the U.S. domestic market, you've got what we call the international market or the European market, and then you've got the Pacific Rim or the China market. So let's take those individually today as we talk, and we'll get a little bit into some of the headwinds and tailwinds that we see in each area. Now, the U.S. presents a unique opportunity, as I alluded to in the beginning of our monologue, because there's some incredible tailwinds. Well, what kind of tailwinds? Well, we're seeing the Fed cut rates, so that means money is becoming more cheaper. We're seeing a market where now deregulation, That means the government is starting to cut the red tape that is needed to be able to be successful. Now, why is that a tailwind? Well, if you have less hurdles to build a business, if you have less hurdles impacting your ability to grow your business, what are you going to do? You're going to have better resources, more revenue, more opportunity to hire individuals, and when you hire those individuals, that's a ripple effect on the economy. Remember, we talked about this multiple times, and you've been on our conversations with our people, but we look at the GDP number, and remember, 70% of our consumer spending goes into the GDP. So when you have an economy where there's more cash and there's more opportunity for people to spend, well, it ripples into the economy and the economy grows. And that is been validated by the consumer spending index that just took place, shows a tremendous amount of increase, the highest it's been in several years. So you've got those two new tailwinds. You're also seeing things like inflation starting to abate. Now that will take a while to ripple down to you and I in the grocery store and the shops, but those are incredible tailwinds. Those are things that help an economy explode or stimulate. From a headwind perspective, the only thing we really would see is some of the geopolitical risk globally, because the U.S. does play a role in that. We don't see a lot of other risks. Now, again, you people have conversations where they'll mention AI and say, well, AI could be the next tech bubble. But there are, as I told you in previous podcasts, there are some incredible support roles that didn't exist during .com that are being built to sustain the AI model. So you've got a little bit more diversity, you've got a little bit more of an even-keeled approach, and that is an incredible opportunity for us if you're looking to invest. And that's why as a firm, we look at for the jewels. There are some incredible jewels out there when you look at the U.S. market, things that the average investor doesn't know about, but our firm works closely and drills down to find. But if you look enough, you'll find those opportunities, and you're talking about substantial yields. Try to stay away from what's happening with maybe some of the younger generation. They're getting so excited about short, quick bursts. They're looking at the TikTok investments. They're looking at the crypto investments. They're looking at gambling investments. That's why you see it on TV all the time. You see that kind of solicitation all the time, because people are drinking the Kool-Aid. They're thinking, I don't have to work hard. I'm just going to put a couple bucks down and make $1 billion. That's not how it works. We can't make $1 million putting a couple of dollars down. There is still systemic resources that you've got to deploy to be investment. Also, don't get caught up or trapped by the banks. You know, the banks, what's in your wallet line you hear all the time. They're promoting credit debt. So again, we always tell you fiscal responsibility is one of the critical components. Don't overextend yourself. If you're only making $80,000 a year, you don't buy a $70,000 car. What's going to happen to your opportunity to buy a house or anything else? So those are the kind of things, again, watching your six is the premise of our show. Looking at the ways to protect yourself, sort of against yourself, is one of the critical components. But going back to our headwind and tailwind analogy, the U.S. market looks like a very, very fiscally responsible, robust market. Regardless of your political aversion, at the end of the day, we're looking at opportunity. Where do I want to look to invest my money? Now, in contrast, you look at the European market, that's a unique market because of its fragility. And what do I mean? Well, when you have 19 countries that are all run differently and separately, but have one fiscal bank, you create an environment that's very challenging. So if, let's say, 4 countries are really fiscally responsible, they don't spend their money, they manage their money well, but the other 10 or 12 countries or 13 countries aren't fiscally responsible, what happens? Well, now they've got to pick up their debt, and there's a strain on the environment. So you do see that in the European market. One of the things you'll see as a telltale is Germany, for example, put a stop now on its debt. It's trying to control the spending of other countries because it obviously picks that up. So when you're starting to see a switch to spending and now becoming more conservative when it comes to your banking resources and your spending habits, that is a good sign for the European market. That means that the European market is coming what we call fiscally responsible. Now, how does that translate to you? Well, if you're looking to invest, you want to start looking at countries that have the opportunity and have done really well in that marketplace. Now, I always use a little bit of an adage. Always look at the beer countries versus the wine countries. I know it sounds funny, but if you look at your wine countries, let's say Spain, Italy, Greece, even maybe France, you'll see that economically they don't do well. Their inflation is typically double digits. Their spending is usually out of control. I don't understand the logic there, but that's what happens. When you look at your beer countries, I call them, you look at your countries like, Finland, the UK, Ireland, Germany, they are fiscally more robust. They do better. So again, I'm not advocating for wine over beer. That's up to you. I have no preference either way, so I'm not pushing that. But it's just a unique trait that you'll see as a pattern, and it's something that maybe you want to look at and review carefully. But the European market does present some opportunity, and now with some of the trade agreements that have been put in place post-tariff discussions, the U.S. and the European markets are going to start trading a tremendous amount of resources, whether it's natural gas, textile manufacturing. So those are opportunities for you. But as I said all the time on the show, don't wait. Procrastination is probably the biggest key, and that's also the reason that we push for fiscal responsibility. Cut down on the spending. Limit the credit cards. Have the cash available to take advantage. If you're wanting to start a business or create an opportunity, some kind of IPO or some kind of entrepreneurship, make sure the opportunity is there and the funding is there. Otherwise, you're going to fail. Now, the third area, China, Pacific Rim, they're almost somewhat consistent with each other, but somewhat separate. As we know, the Pacific Rim is that whole area, but China really is a standalone. China doesn't do a lot of business with Korea and Japan just because of cultural other reasons. Now, China as a whole is actually in a big hurt. Economically, China's economy is doing very, very poorly. When you hear some of the numbers that are coming out of China, remember, those numbers can be fabricated. They don't have a federal transparency like many other countries do, so they can report all kinds of astronomical numbers, and there's nobody to call them on it. But economically, you're seeing their GDP numbers, that's the growth of their economy, even though it's a huge economy, isn't growing at the speed it should. You're seeing a tremendous amount of debt buildup. You're seeing a consolidation. So now what you're seeing is the limited middle class that they have in China really doesn't exist. It's getting hurt. So China is really in a unique, vulnerable place. They really rely so heavily on export of their goods, and now post-COVID, with so many countries getting their feet into manufacturing, more manufacturing coming back to the U.S., you're seeing that as an area of weakness. So I would personally be weary of China. I don't necessarily like investing in that marketplace, i.e. transparency, but also the fact that economically they're starting to really sort of weaken. I see that as an Achilles heel with them. Some might debate that with us. The market share, meaning the amount of people there, is why so many of our companies like to get into there. You're talking, an incredible volume of people. But if you're giving up half of your company, or if you're giving up the literacy, or you're giving up the security, or you're giving up the confidentiality of your organization to invest in a country, is it really worth it? I mean, that's my opinion. I don't really think the piracy that takes place with them is astronomical, and the intellectual property that's stolen on a regular basis. So I think China is a weak marketplace. I think you have other what we would call emerging marketplaces like India. That's an opportunity. Pacific Rim, there's still great opportunities. I mean, Japan and Korea and Indonesia, the list goes on and on. But again, coming back to what we see as the bigger of the economic powerhouses, there are less headwinds and more tailwinds in the U.S. market or domestic market than there internationally. So why expose yourself? I mean, that's just my thought process. But again, as we always describe, talk to your team. If you don't have a good financial team, feel free to contact our firm via DM or email, but make sure you have a team exposing the pros and cons to everything so you can really understand what's transpiring. Now, one other thing we want to talk about, and we alluded to a little bit in our show, is the propensity to jump ship and start to look for the quick buck. Too many individuals will listen to a 30-second soundbite on Instagram or social media site, and no offense because we're on Instagram, we love it, but they'll listen to information they have no idea where it came from, was it validated, is it an opinion piece or an actual research piece where data was conducted, and they'll act on it. And then what surprisingly enough happens is they get burned. So fight that tendency, especially the younger generation. Fight, I know you love it, I know you spend hours on it, but fight listening to TikTok or Instagram or Meta on exactly what you should do with your investment until you do your research. There is good data out there on all those platforms, don't get me wrong, but fight the propensity and the tendency to say, well, you know what, I've got a short time, I want to make $1 billion, I think I can do it this way. Because the reality is it doesn't happen. day trading, it was a unique model that just came on the scene probably, I want to say 15 or 20 years ago. And the regulatory commissions actually highlighted about a 4 trillion, it's probably up to a 5 trillion a day goes in between day trading. That's a huge number. So you think about it, $4 to $5 trillion a day, you'd think the percentage of people that make money would be fairly high. Do you know what the percentage of individuals of day trading make actual positive profit is? 1%. So you're talking $4 to $5 trillion a day going back and forth. People are trading, and really only 1% are actually making money. And you know those people. Those are the people that will say to you, oh yeah, I made $50,000 yesterday, or I made $10,000. And then I'll typically ask them, well, what did you keep? What's in your bank? You made 50 yesterday, but the second day, what happened? We saw that with crypto. I mean, look what happened. We discussed on the shows multiple times our concerns with crypto, and one large crypto entity dropped and gave up almost all of its earnings. It's back to where it was just a couple weeks ago, and still hasn't recovered.
Yeah.
So, you know.
And back to your point, not a lot of influencers on TikTok say things that's not going to be applicable to you. Everybody's situation is very different, so you cannot take this advice, just think it applies to you directly.
That's a really good point. So Nicole touched on, again, that's why the planning aspect has to happen. You got to get a good team, because not everybody takes the same amount of medicine. Not everybody takes the same amount of, particular ingredients. So if they're going to highlight something and it's a broad spectrum, and they got 2 million followers, you think all those 2 million followers like the same meal? Have the same needs? No. So you're going to take an advice that's generic in nature, that you feel is going to auto-populate and work, and then you jump on it and you're wondering, wait, now what do I do next? So that's a really good point. So those are some of the things that we wanted you to be careful with and be concerned about, and those are the things we want you to think about. Don't get stuck on the quick buck. Remember, we highlight all the time, have a team of individuals that are analytical, and don't let your emotion dictate your policy. That's another thing we see. We have people that come in, for example, that have made, decent money off of renting houses. So they know real estate. They love real estate. They'll argue with us, well, I want to invest in real estate. That's all I want to invest in. And we're like, well, then what do you need us for if you think that's the route? The problem is they fell in love with the investment, not the rate of return. And I'll tell people all the time, I fall in love with the interest rate of return. I fall in love with the growth. I don't care what it is. If I invest in butter and butter makes me 32%, that's great. If I invest in diamonds, make me 32%, that's great. I'm investing in the rate of return, not the actual asset. So don't let your emotion override what really should happen. So when we talked about diversification in previous shows, we've talked about asset allocation in previous shows, we talked about procrastination in previous shows. Those are areas that you have to not let your emotion override your logic. Get involved, have a good team of individuals that you can bounce things off of, and then let them sort of guide you, and trust the method, trust the process. Does that make sense, folks? All right, so we asked Nicole to be here today because we're going to have Nicole do Jason's Fast 5. So Nicole, I'm going to let you take over and go into Jason's Fast 5. Nicole Verde, one of our planners.
Thank you, Jason. So just to start off, we have DraftKings. It is no longer just sports betting. They just introduced a platform for predictions markets.
So that sounds like algorithms.
Yeah.
Yeah.
And it's a little less like gambling, a lot more like trading, but it will all be wrapped into a familiar app.
Right.
It's exciting, but it is concerning because it blurs the lines between investing and gaming.
And that goes back into what we just talked about in the show, how the younger generations are getting sucked into, I like to say sucked into, they're getting sucked into the quick fix, the quick money. So now here's another app, and you don't think they created that app because it wasn't profitable.
No, I mean, I know a lot of people personally that do those sports bettings and lose a lot of money because they just...
And that's why they do it. They wouldn't build it, and now they've made an app that, like you said, blurs the lines between gambling and investing. So that's a scary place to be, but be aware of it.
Yeah. Then we had a lot of buzz this week after federal government signed an executive order rescheduling cannabis from a Schedule 1 to a Schedule 3 substance. Now, for cannabis companies, essentially that may make it easier for accessing to banking and less legal friction. However, the markets quickly realized this wasn't full legalization, and there's still lots of uncertainty.
Right. And see here, that's another problem that comes up because federally it's still legal. So the company technically couldn't report earnings. So why would you invest in a company that you can't track the earnings?
Yeah.
So I would be careful of that. They talk about how much money it's going to make, but frankly, all I've heard so far is a lot of illegal money. Until it becomes fully legal, it's hard to track, and they can't report earnings. So that might be a fear, but I can understand that. Yep.
Yeah.
That's a good point.
Then we have one of the more interesting crypto stories came from Hong Kong. So a regulated crypto exchange went public and raised around $200 million. Now, this isn't just about meme coins or hype. This is a legitimate company that's now listed on a major financial hub. Any thoughts on that, Jason?
Well, that is, how I feel about crypto, folks. I've talked about before, because transparency. That may be a good step in a direction, because now there is a level of transparency. But you said it was based where?
In
Hong Kong.
Hong Kong.
So it's on an exchange. I'm assuming the Hong Kong exchange. So the oversight might be a little bit sketchy.
Yeah.
And that those pop-ups seem to be happening all over the world. They pop up and they last 3 days. People make a run for the money and then they get tracked down. So again, folks, I'm still weary of crypto. I would think when they get on a more well-known exchange, like you were saying, then maybe we could look at it. But it's a step in the direction. So essentially, crypto's got the opportunity to be online with that and maybe have a little more transparency. But we'll see what happens.
Yeah.
What's the next one you got?
So then we have Citi and London Stock Exchange Group. They just teamed up on a major data partnership. So this sounds a little boring, but for today's markets, data is everything. So it drives trades, risk decisions, and pricing.
Right.
Essentially, quiet deals like this one shape how money is actually moving behind the scenes.
Right, yeah, and we talked about with AI, the biggest thing is coming to be data sharing and data consumption. So one of the biggest things is if there's a creation of data sharing or expansion of data opportunity, that can be a support role. So that's an area I've told you folks, keep an eye out, investing in data spaces. And remember, alternative energy, i.e. nuclear, is begun to come because energy drain is massive when it comes to AI. So that's something we see a lot of.
Yes.
And what's the last one?
Lastly, so Alphabet just dropped a pretty significant move after the company agreed to buy a energy and data facility. It is called Intersect, and it was a $4.75 billion deal.
So now what's that telling you, folks? I've told you the areas you want to look at are data and energy. And then here's a large institution dropping money in what area? Data and energy. We're not making this stuff up. The podcast isn't irrelevant. We're sharing data with you. You just have to act on it or call our offices, other groups, and get more information from your team.
Yeah.
That's great.
And that wasn't only just a big tech buy. Essentially, they're trying to secure their power for Alphabet's immense AI database.
Right. They need to protect the power, they protect the intellectual property, they protect the asset, all those things go on. Exactly. Well, Nicole, that was great stuff. Thank you so much, and thanks for having you on the show, and we look forward to having you back. I'm Jason Edwards with Watch Your Six. Make sure you tune in next week. We hope you enjoyed this episode. And as I mentioned at the beginning of the show, our ebook is now live. So in our Instagram post, our DM post, our website, click on the links there and we'll be sending you one free copy of the ebook. The ebook is critical to your planning, so I think everyone enjoy it. And we also encourage you to start DMing us again your questions. We love covering your topics, or make your comments on our YouTube site and we'll get those into the show. I'm Jason Edwards of Watch Your Six. Have a great week and be safe.